lecture, I like to say something about the downturn of stock market of India. And you know, in very recent time, there is a downward trajectory in the stock market. And what are the factors responsible for this? In this lecture, I will try to spread some light on the factors that actually determine the downward tendency in the stock market. Actually, to have a clear idea about the downturn of the stock market, BSE, Sensex and Nifty 50, you know, the most important stock market in India. And for this and for clear understanding, I would like to show some time plots. I have shown some time plots. You know, there are Nifty 50 time plot, and there is USA interest rate, and you know there is nominal and real exchange rate, and also there is, you know, the current account deficit of India. And on that basis, and also the inflation rate of India. So these are the factors I would focus on these, and how the stock market is actually the downturn is there, and on that basis I would spread some light. You know, Donald Trump is imposing some tariffs in some goods, and there is some uncertainty in the international trade and the impositions of tariffs. And mostly in the recent times, this uncertainty actually the main reason for the downturn in the stock market. So you know that if there is a impose of tariff, then naturally the cost of production of some goods, of that particular goods, will increase, and as a result it will have an inflationary pressure, and this inflationary pressure will be responsible for less production of particular goods. So, and these goods actually the performance of these goods is actually can be found in the mirror of stock market. You know, the stock market is a mirror of economic factors that are actually happening in the economy, and that can be reflected in the stock market. So tariff has some negative effect in the stock market. And now, there is other important factor, that is the foreign institutional investments. And foreign institutional investments, or you can say the foreign portfolio investments. These investments are going out from India, and just because of high interest rate in USA, and there is some certainty in India. In India, there is no such return if the foreigner invest money in Indian economy. So there is a less return, and they are getting more benefit investing in USA. So money is going out. Okay, money is going out. So this is the main reason for the downturn in the stock market. And now you look at another thing, that the nominal exchange rate is falling. And the nominal exchange rate, if there is a depreciation of a currency, and you can find the depreciation in our currency, that is the Indian currency per dollar, and this depreciation hopefully should increase the export, but that is not happening in India. And if the export is increasing because of the depreciation of the exchange rate, then some positive effect you may have in the exchange rate, because export will increase. We know from the theoretical background, that is the Dornbusch-Fischer goods market hypothesis, you can have this understanding that if there is a depreciation of the currency, the export will increase, and as a result, the products that is related with the export will increase. So the stock market will be good at the time. But if you see the data, the historical data of real exchange rate and nominal exchange rate, then you find that the nominal effective exchange rate and real effective exchange rate, there is a difference. In the last 10 years, there is a difference, and that difference has some negative effect on the stock market. And real exchange rate is appreciating. On the other hand, the nominal exchange rate is depreciating. So nominal exchange, and for that reason, the divergence between the two is not good, and export is not increasing because of export is not increasing for the depreciation of the Indian currency. So this is a reason, and there are you can have some factors I can mention here, that is the tepid domestic earnings, gross domestic earnings, and elevated valuation of the small and the small and mid cap, and also some also the persistent inflation rate above the threshold of the RBI, that is the 4%. The inflation in the time plot I have shown that the inflation is above in the Indian economy, over the 4%, and over the 4%, and the threshold mark given by the RBI is the 4%. So it is above the 4%, and it has some negative effect. And another thing is that some geopolitical imbalance are there, and you can say that these factors are more responsible for the downturn trajectory in the stock market. But consistently the outflow of the foreign institutional investments is one of the main reasons. And in the balance of payment, there is two account. One is the current account and another is the capital account. And over the periods near about the 10 years, the current account deficit is there, and the balance of payment is balanced by the capital account, because capital inflow was there. But now the contradictory thing happens. The current account deficit is there, as well as the capital outflow is there. So it is not good for the economy of the India. So you can say the downward movement or downward trajectory in the stock market trajectory in the stock market is actually found because of these factors. But hopefully the foreign investment will come back to India. But there is some uncertainty about the time span when they will come back. That matters. And if the foreign investment will come back, then again the performance of the stock market will be good. And to some extent, the mutual funds, that is the investment by the households of the India, to some extent actually reduce the impact of the outflow of foreign institutional investment. And in this way, actually, I would like to analyze the downturn trajectory of the Indian stock market.